So I've explained that investment companies are quoted companies, and they're normally compared with open-ended funds, things like UCITS funds and OEICs, unit trusts. And the main difference between them is that the investment company is what they call a closed-end fund, which means it has a fixed number of shares, whereas an open-ended fund expands and contracts whenever anybody wants to buy it or sell it. Because there's money flowing in and out of an open-ended fund all the time, one of the worries is that carries a degree of short-term thinking by the person running it, but also it means that they have to hold fairly liquid investments. That means things that they can buy and sell quite quickly to be able to meet redemptions as they occur. So if somebody wants their money back, they've got to be able to sell the underlying investments quite quickly to pay them back. Whereas the closed-ended fund, the investment company, doesn't have to worry about that. And because they can take a long-term view, they can invest in a wider choice of assets. So they can invest in things that are more illiquid, so they're harder to sell. So good examples of that might be something like property or renewable energy investments. The way that the prices work between the two differs. So in an investment company, the share price is determined by supply and demand. So if a lot of people want to buy the investment company, then the share price will go up. And if a lot of people want to sell it, then it will go down. With an open-ended fund, the price is based on asset value. So if you add together all the value of all the underlying investments and the cash and take away what you owe, then you've got the net assets, and divide that by the number of units in issue, then you have the net asset value. So because you've got a share price and a net asset value in an investment company, and obviously sometimes the shares will be trading higher than the net asset value, which means they're trading at a premium, and sometimes they're trading lower, which is a discount. This is quite a difference between that and the open-ended fund. Buying things at a discount is great because you're actually buying the pool of assets for less than it's actually worth. And it can be quite good news to do this, especially if the discount narrows. One of the strongest things that I think closed-end funds have is that they have a board of directors who's completely independent of the manager, and their job is to look after your interests. So this board of directors, they have a legal responsibility to do what's best for you, and that can include even firing the manager. And even better than that, because you're in a company, you actually get a vote. All the shares get a vote, and that means if you don't think the board are doing very well, you can vote them off as well. And then the last thing that is usually seen as an attraction for investment companies is that they can borrow money more easily than open-ended funds can. And that's helped by the fact that they've got this fixed pool of investments to draw on. So one of the attractions of investment companies is that you can borrow money. We call that, as a technical name, gearing. And that just really means that you can dial up the returns by borrowing some money and dial it back down again by paying it back again. And the beauty of gearing is that when you think the market's going to go up, you borrow money, you invest in the market, the shares go up, and then you repay the debt at a future date, and you've made more money. The quid pro quo of that, if markets are going down and you've borrowed money, then you're going to lose more money than you would have done otherwise. And that just means that gearing does involve a degree of risk. But by and large, the way that boards look at this situation is they limit the amount of gearing that can be used, and they try and minimise the risk to shareholders.